Good morning and welcome. My name is Brian Siegel. I'm BUI's Director of Advanced Planning, and I'm very excited to introduce our speaker today. But before I do, I have a couple of quick housekeeping items. First, this meeting is approved for 1 hour of CE credit for CFPs anywhere in the US, Missouri Life and Health, Texas Life and Health, Indiana Life and Health, and Missouri MCLE. We will post a link in the chat to sign in for CE. And if you'd like credit for today's presentation, please make sure to complete the form accessed through that link. Second, if you have a question during the presentation today, please post it in the Q&A. We'll do our best to answer as many questions as time allows. Now, today's topic is one that continues to be an essential part of the planning process for clients, especially for those who've had a loved one need care at some point. And let's face it, for most families, they've had some kind of long-term care experience in the family. Long-term care planning is top of mind for most clients, and frankly, if it's not, it probably should be. So today, you're going to hear from BUI's Vice President, Brant Steck, on this topic. Brant leads the charge in all of BUI's marketing efforts, and he's not only a great speaker, as you'll see today, but he's also an excellent resource available to you and your clients. He's truly one of the smartest guys in the industry, and with his excellent communication skills, understanding of clients' planning needs, and his vast product knowledge, Brant is the guy you want at the table or in your Zoom meeting, as the case may be, educating your important clients on their life and long-term care insurance planning options. And today, Brant is going to discuss the basics of long-term care insurance planning. So without further ado, Brant.
Thanks, Brian. Very excited about this presentation. At BUI, I think many of you know, we do pretty regular webinars, usually quarterly, and we try to create topics that are of interest to the financial services professionals with whom we work. Sometimes it's about buy-sell planning or executive benefits or working with high net worth clients in their trust planning. Sometimes it's specific to life insurance and index products and mechanically how they work. I think there's value in all those things, but in terms of broad value to the masses, this is a presentation I feel really good about because I feel like I can directly see how this presentation can bring value in improving the quality of life for your clients in their retirement years, can improve the quality of life for their loved ones. And it's funny because I talk to so many financial planners, and it seems to be there's a consensus that one of the biggest risks, if not the biggest risks in retirement, is an extended stay in a facility. And yet there seems to be a fundamental discomfort with long-term care insurance. And I think that stems from the traditional products of yesteryear with those highly publicized rate increases. But today the products are much more robust. They're chock full of guarantees. And there's so much value that you can bring to your clients in having this discussion. And my goal today is to help you feel more comfortable in understanding the need and how to communicate that need to clients and basically how the products work. The reality is that, in the life insurance world, there's hundreds and hundreds of products from hundreds of carriers, and they can be very nuanced. With long-term care, the market is relatively small. There's only about 5 or 6 carriers that are really competitive, and their products really mechanically work in a very similar way. So I think if you follow with me today, it will lead you down a path of being much more comfortable having a conversation with your clients about the need and ultimately helping them provide guidance on what product solutions might make the most sense for them. So today we're going to talk about long-term care overview. So what is long-term care and what isn't it? So when we're talking about long-term care, how's that different than medical insurance? And what does it cost? And what are the ways my client could ultimately pay for this? Then we're going to get into the need to plan and why today in America, in particular, unlike any other time, the need to plan is really at a critical point. We're then going to go over the basics of long-term care insurance. That's how all the products work. So regardless of the carrier in the product that they're offering, how they're all structured, then we'll get into how to communicate the benefits from a product perspective to clients. So like if you're looking at an illustration, how do I interpret this, and how do I help my client frame meaning around this? And then we're going to go over some key takeaways, what you can do today to start building this into your practice. So let's start talking about from the very beginning, just a broad overview of what is long-term care. Long-term care does not replace the need for medical insurance, a common misconception with a lot of clients. The easiest way to think about it is it covers what medical insurance doesn't. Any client who is considering long-term care needs absolutely needs medical insurance. Medical insurance is for medically necessary care that's done by a licensed medical professional. White coat. They have alphabet soup after their name. It's the doctor, the nurse practitioner. When we're talking about long-term care, what we're really talking about is custodial care that doesn't necessarily need to be done by a licensed caregiver. So think about it like this. How did we all get into this meeting today? Well, we all got ourselves up, out of bed, moving around our homes. We were able to bathe ourselves, dress ourselves, use the facilities, feed ourselves. When we become unable to do those things for ourselves, the things that we all take for granted, and we need somebody to help us, that's custodial care. Doesn't need to be a licensed medical professional, just somebody to help you with your clients with your activities of daily living. And the reality is it's not inexpensive. What you see here is the median national cost of care across the country. And on the left-hand side here, you see in-home care, where you have homemaker services, home health aides. Then you have community and assisted living before entering a nursing facility. So it's sort of the spectrum. And what you see over here on the left-hand side is what the 2021 costs were. We don't yet have the 2022 numbers, and what is projected to be in 20 years. And you can see even just homemaker services are quite high. And then you go to the other end of the spectrum and you see a private room in a nursing home at $9,000 a month, today projected to be $16,000. And I have to be honest with you, those are based upon, historic inflation rates. I think there's good reason to believe that those numbers in 20 years are going to actually be much higher. It's very clear that there needs to be some draw into bringing caregivers into these facilities, whether it's a facility or home health care. The way to attract people into any kind of occupation, money. And when we're in a supply and demand crisis, I'm going to talk about in a minute, I think there's good reason to believe that these are underinflated numbers and that the numbers will actually be much higher. But also remember, these are the median national costs. The highest cost in the nation, the highest state in the nation is Alaska, with the average cost being $175,000 a year for a private room in a nursing facility. Arkansas being the lowest cost. And if you're in the Midwest, it's probably closer to these figures. But when you go out to the coast, so you go out to the West Coast, particularly in the San Francisco Bay Area, cost is super high. Same thing on the East Coast, in New York, Manhattan, the highly dense, densely populated areas with a higher cost of living, the cost is quite high. So you can imagine, if you have a client who's accessing their portfolio So a married couple accessing their portfolio for potentially 5-figure per month distributions while the other spouse is still having their normal living expenses, you can see how this could be really, really negatively impactful and potentially catastrophic, and a risk that makes a lot of sense to transfer. So the question at this point is, who is going to pay for this? What are the options to a client for paying for long-term care services? Well, the first option is Medicaid. Medicaid is a federal program that's administered by the states, but to be clear, it is a welfare program. In order to qualify for Medicaid, the total assets for a client must be under $2,000. And even when you consider exemptions for primary residence, vehicle, funeral funds, etc., Medicaid is unlikely to be a solution for your clients. The financial planners on the call, most of you have an asset minimum of $500,000 or higher. So the likelihood of any of your clients thinking about an asset limit of $2,000 is, in their minds, literally worse than death itself. So unlikely that Medicaid is going to be a solution for your clients. So then you go to Medicare. Believe it or not, 49% of people over age 40, 49% of people over age 40 believe that Medicare is going to cover their long-term care needs. And yet, on Medicare's website, it says for days beyond 100, Medicare pays nothing. You pay the full cost for covered services. So there we have a disconnect where people think, well, the government's going to be able to take care of me. Those funds are not provided for custodial care. Medicare is for medical needs, for skilled practitioners. Then you have legislation. So interesting. At a federal level and at a state level, our government officials are looking at what's happening across the United States and thinking, we've got a problem. At a federal level, in every Congress for the last 17 or 18 years, there's been a bill proposed for government assistance in providing long-term care. They never go anywhere. And usually it's like, helping caregivers with Social Security credits and things like that, not actually providing for the cost of care. But they seem to get lost in committee. You see them in the news, they go to committee, you hear nothing. So states are starting to figure out, okay, we are going to have a problem where we have a lot of people that need care. And what are we going to do with those people? And how are we going to be able to provide the care? What you see on this map is there's 13 plus states. So now Pennsylvania is included too, that are at some stage of research and development for addressing long-term care at a state level. The first state that actually passed legislation and enacted it was Washington. In short, it went very, very poorly. But basically the way it works is 58 cents on every $100 is taxed as a payroll tax, and it's uncapped. So the actuarial figures in the state of Washington before the program was established expected 100,000 people to seek exemption. You were able to seek exemption by having a privately owned long-term care insurance policy. While they're expecting 100,000, almost 500,000 actually sought exemption and got approved. So actuarially, a problem where you have the highest income earners getting private long-term care insurance and opting out of the plan. But whether it's Washington or any other state, nearly all of them have a very low benefit. So Washington's benefit and the other ones I've seen are pretty similar. The lifetime benefit is $36,500. So just to be clear on what I mean by that, not once you qualify for claim, you get $36,500 every year. $36,500 for a lifetime. So here you have people paying this significant tax, like Social Security. You got to get 40 quarters in to get the full benefit being $36,500. And relate that back to the slide I just showed you. $36,500 is horribly insufficient for even a year of care. And so the concern is that this is going to create a false sense of security for a lot of people. They're going to believe that, oh, the state's got me covered. The state does not have them covered. Who's going to benefit most from this type of legislation is low-income families who are not going to qualify for Medicaid. For everybody else, it's a drop in the bucket. May help a little, but not a lot. So from a planning perspective, these first three really can't be relied upon. So who will pay for it? Well, you have the option to pay out of pocket. Your clients certainly have the option to take portfolio distributions. But does that make sense? So government statistics suggest that 70% of those over age 65 are going to have a long-term care event. 70% of those over age 65. So when you consider a married couple, that number just goes through the roof. So there's two things that you can't time. You can't time a long-term care event, and arguably pretty difficult to time the market. And if you're taking assets from a portfolio, you're trying to coincide the timing of a long-term care event at a favorable market time. And if it doesn't coincide, your clients could have a real problem. In other words, think about the last 12 to 18 months. You know, there's been some good market days. There's also been some pretty bad days in the market. Think about when the market was down 20 or 30% and having to take major distributions out of the plan or out of the portfolio. Can that portfolio recover? And that's where really long-term care comes in. Long-term care insurance is being able to remove that risk from the portfolio, relieve the stress on the family, and give your client the best chance to get the kind of care that any of us would deem acceptable. And if one of these two options, the portfolio or the life long-term care insurance, isn't available, there is a default. And a lot of people don't realize, like, there is a default. If you don't plan, what happens? What happens is it lands on the shoulders of the adult children. And nobody, knowing the facts of the impact on the adult children, would ever plan to put that on them. And yet it happens so often. And we're going to talk a little bit more about that. So we talked about what long-term care is, what it costs, and ultimately who and how it can be paid for. But I started my comments today saying we're at a catastrophic level in this country. Like, we're bursting at the seams. There are not enough people in caregiving positions for the amount of people that need care, and it's about to get worse. And I think the natural thought is, well, if that's the case, why isn't this in the news? Why is this not on the front page of every news publication in America? And the reality is, it is in the news. It's all over the news. It's just not on the front page. What is on the front page? It's the fire at our feet. It's the war in Ukraine, inflation, tensions with China. It's all those things. But it's not the clickbait type of material, and it's not the immediate what's happening today. And knowing that we're on a path where it's about to get worse, as financial service professionals, we owe it to clients to make them aware of what's happening. So let me put this in a better perspective here. So first of all, I mentioned 70% of those over age 65 are going to have a long-term care event. That's a statistic. My guess is that the majority of you have heard. Here's a different way to put it. The baby boomer population represents 70 million people. Huge generation. The youngest baby boomer is age 58. The oldest baby boomer is age 76. The average nursing home admittance age is 79. So there's a lot of people on the doorstep of needing care. Between Generation X and millennials, we have another 137 million. So just using rough numbers, there's about 2 non-baby boomer adults to care for every baby boomer. Now, we have Generation Z that's still coming up. They're still entering adulthood, still trying to get their feet under them. Many of them still in school, still living with their parents, still striving to, become a part of, productive society, and they will be helpful. And they're a big generation, but even when they advance into adulthood, we're still talking about a ratio of 3 to 1. And while not every individual is going to need care, and certainly not all at the same time, these numbers just aren't sustainable. I mean, think about it. How many professional caregivers do you know? Probably not too many. And to kind of highlight this problem, the American Healthcare Association did a poll, not a poll of 10 or 20, a poll of 1,200 facilities all across the United States. And 99% of nursing homes and 96% of assisted living communities said that they're facing staffing shortages, with 59% of nursing homes and 30% of assisted living communities describing it as severe. How severe, you might ask? So severe that 6 states, so New York, New Jersey, Minnesota, Maine, New Hampshire, Indiana, have had to deploy the National Guard to help seniors with activities of daily living, to help empty bedpans, give baths, distribute meals. Things that the National Guard was not intended to do. But that is where we are as a nation, busting at the seams. So what's really contributing to this is that people are really starting to live a long time. And I know this is a lot of colors. So purple is women, gray is men, dark blue is a couple, at least one living to a specified age, and light blue is the probability of both living to a specified age. I want you to look at age 95. Here at age 95, 46% chance that at least one of 2 in a married couple is going to live to that age. Now, what do you think the chances are that somebody that lives to 90 or 95 is not going to need care? That person that lives to 95 or 100 not needing care is a unicorn. That's very improbable. Most of us, if you live a long time, you're gonna need help with activities of daily living, whether it's because you're physically unable to do it or because you have memory issues in a form of dementia, and you're just not able to do these things for yourself. So I mentioned that if a client doesn't have a plan, and most of them don't, statistically 14%, according to a poll that was conducted by Lincoln, have actually talked to their financial planner about what they're going to do with this. I think in this community, it's probably much higher from the planners that I know. But if you don't have a plan, the default plan becomes the family. And this chart demonstrates the significant mental and physical impacts of a family caregiver compared against the benchmark public. In other words, a family caregiver is 64% more likely to suffer from hypertension, 50% more likely to be obese, 42% more likely to have a major tobacco use disorder, and you can see the list goes on. And you think, well, wow, yeah, I wouldn't want to put that on my family, but how many people are actually dealing with this? A mind-bending number. In America today, 53 million Americans are providing unpaid care to a family loved one. 53 million Americans. That's 1 in 5 American adults is a family caregiver. And the thing is, like, I, I like to believe, and I firmly do believe, most people are good. Most people want to do the right thing for their loved ones. And I think there's a natural perspective, excuse me, perspective that, look, when mom and dad need care, I want to be there for them. They gave me everything. They gave me every advantage in life. They brought me up in my childhood. I wanted for nothing. They cared for me when I need it. And darn it, when I need care or when they need care, I want to be there for them. I love that. And I think that's a very noble perspective, and it really comes from the heart and it comes from a good place. But is it coming from a realistic place? I think when people say things like that, they don't really understand what they're committing to. On average, a family caregiver is providing 24 hours per week of care. What does that caregiver look like? Statistically, it's the female spouse or the oldest female daughter. And when you hear long-term care referred to as a woman's need, that's why. It sounds chauvinistic. I cringe to even say that. But women are disproportionately impacted by long-term care as care recipients, because they live so much longer than men, and as caregivers. So think about that oldest female daughter. 24 hours per week. On average, this is a 49-year-old female. What's life like at 49? Well, maybe married, maybe has kids that are pretty active in sports or getting ready for college. 49 years old, probably employed, entering their peak income earning years, and then trying to provide 24 hours per week of care. Imagine trying to have a part-time job that's 24 hours per week on top of your full-time job. That's a lot. That's a lot. And then when it's caring for a loved one and the awkwardness of provision of care, that's a lot to ask from somebody. The reality is that at age 49, if you're providing 24 hours per week for care, you're probably going to have to cut back at the part-time or at the full-time job. That means less earnings. That means less retirement contributions, less Social Security credits, less employee benefits because maybe you've gone part-time. And then you combine those financial factors with the physical and mental toll. And I don't think anybody with that knowledge would have the plan B to have a family member provide the care. And yet that is what's most commonly happening, is that family member is being put in a terrible position that really impacts their relationship with their spouse because they're not at home with their children, and affects the relationship with the loved one needing care. And I think a lot of families believe that, well, by having a family member provide this care, ultimately they're saving money. There are studies that show that it's not saving money, that it's just transferring the financial obligation from the care recipient generation to the caregiver generation, with the average cost to that 49-year-old female being $180,000. And again, no one would knowingly want to do this. And I can tell you, having had a lot of conversations with clients over the years who are proactive and are pushing the envelope with their advisor that they want to talk about long-term care, every time the person who's proactively pushing the discussion, it's because they've cared for a loved one. They've provided the care, they've seen it firsthand, and they never want to put that duty onto their children or their loved ones. So that's where long-term care insurance comes in. Long-term care insurance being an opportunity to transfer the financial risk, but also to transfer away the risk of adversely affecting the next generation and their quality of life. After many years of talking to financial planners, I feel like when you hear long-term care insurance, this is kind of the image that you think of. When the client goes there, something to pay the bills. And sometimes it's even referred to as nursing home care. Let me be clear. This is not the goal. This is the goal. The goal is for the client to be able to stay at home where they're comfortable as long as they can. The carriers with the biggest blocks of long-term care insurance business, being Genworth and Lincoln, have very similar statistics that between 70 and 75% of long-term care insurance claims are paid for home health care. So it's not about nursing home care. It's about bringing care into one's home where they're as comfortable as they can possibly be. So I mentioned at the beginning that if you stay with me here, we're going to go over how all these products work. And I'm going to go over 5 or 6 definitions here that, regardless if we're talking about traditional long-term care or hybrid long-term care, despite the carrier, if you understand these definitions, you'll understand any long-term care insurance policy that you pick up, any policy statement that client brings in, you'll have a very good idea of how it mechanically works. So let's go over some key definitions. First of all, indemnity and reimbursement. This relates to how will the client be paid by the insurance carrier. All things being equal, I think most of us would prefer indemnity. Indemnity means that once the client qualifies for claim, they get a check in the mail every month for the maximum monthly benefit. If the maximum monthly benefit is $5,000, you check for $5,000 every month. So if you do have a family, or the client does have a family member that has to come in and provide some level of care, there's at least a way to financially compensate them for doing it. And generally speaking, the quicker you can get money out of a life or any insurance carrier, the better off you probably are. The other method is reimbursement. Reimbursement, the client submits receipts to the insurance carrier and gets reimbursed up to the monthly maximum. So the monthly maximum is $5,000 and they spend $3,000, they're going to get reimbursed $3,000. Now that $2,000 doesn't go away. It stays in the client's pool of money. So that they're still going to benefit, but it takes longer to squeeze all the money out of the insurance carrier. Now, like I said, all things being equal, I think most of us would prefer indemnity. But in the market, historically, most plans are reimbursement. And the reason being is that historically, they're about 20-25% less expensive. In today's market is actually very unique in that there are indemnity products available today that are at a commensurate level as what's available on the reimbursement plans, sometimes even less expensive. So, but that's not normal market conditions. The monthly benefit is the benefit that the client gets each month. There's a maximum amount that they can get each month. That's the monthly benefit. The benefit period is generally stated in months. And the benefit period is on an indemnity plan, because the client's getting the maximum amount per month. It is the maximum amount of time the client can be on claim. With a reimbursement plan, that benefit period is really multiplied times that monthly benefit to create a pool of money. And that pool of money, the client can get up to that monthly benefit every month. So that 4-year benefit period, that 48-month benefit period, isn't so much a maximum amount of time that the client can be on claim. It's actually a minimum amount of time they're going to be on claim if they're not reimbursing the monthly maximum each month. Elimination period. It's like a car insurance deductible. It's the amount that the client is responsible for before care kicks in. But instead of being stated in dollars, like your car insurance deductible, it's stated in the amount of days that the client has to provide their own care before the insurance will start providing benefit. Today's policies, many of them provide a 0-day elimination for home health care. Great. And a lot of times those days count towards the calendar days needed for the elimination period in a facility. So very client friendly. And then lastly, you have inflation protection. Inflation protection is super important because what inflation protection does is it helps to make sure that 25 years or so down the road that the client's benefit levels are buying a similar amount of care that they would be provided today. So the average age of a long-term care insurance policy purchase is age 57, knowing that they're likely going to be in the early 80s at the earliest in most cases to actually start needing care. Inflation protection is really, really important. So they're basically, so those are no matter what type of plan you're talking about, those are the really important definitions. And then you just kind of have a fork in the road in terms of product. Product is generally going to be traditional long-term care insurance or hybrid long-term care insurance. Generally, when you see the bad press, it's related to the traditional long-term care insurance. Traditional long-term care insurance is just long-term care insurance. And the reason it's got a lot of bad press is because of the very highly publicized rate increases. If your client's coming in and saying, I've just got a 40% increase on my long-term care insurance, they're talking about a traditional plan. Insurance carriers and insurance agents alike did a relatively poor job of communicating to people that these were not fixed guaranteed premiums. And so what happened was people enter retirement on a fixed income, and then they get these rate increases, 20% this year, 40% next year, 80%. Every carrier in the market who provides traditional long-term care insurance has had regular large rate increases. Nobody's immune. And because of those large rate increases, in combination with the use it or lose it product design, in other words, if the client passes away or decides to surrender the insurance, there's nothing back. Traditional long-term care insurance is a small fraction of the products that are purchased today. The vast majority of the market has shifted to hybrid life insurance, long-term care, hybrid plans, which are life insurance policies with long-term care insurance riders. I hate saying that, life insurance or long-term care insurance rider, because I feel like anybody that has experience with life insurance views a rider as like tacking it on. It's like fries with your burger. You're buying the burger, but the fries are on the side. Not how this works. People buy these hybrid plans not for the death benefit. The death benefit is a secondary or tertiary benefit. The primary benefit is the robust long-term care benefits. Guaranteed premium by contract, guaranteed premium duration. So the client wants to pay single premium, 10 premiums, pay for their entire life, guaranteed. Guaranteed long-term care pool, guaranteed inflation protection, guaranteed death benefit, guaranteed return of premium flexibility. So it's been an answer to, it's the industry's answer to these traditional plans where you don't have rate increases and the client knows no matter what, that the dollars they put towards this plan are going to be used. They're going to be used either for long-term care, a death benefit, or the client could just get their money back. And it's a simple concept for clients to understand. And we're going to talk about conceptually how to communicate that. One question that commonly comes up at this point is, well, how is my client qualified for claim? There are two ways. First is the client's loss of functional capacity. In other words, their inability to do 2 of 6 activities of daily living, as attested to by their physician, is what qualifies them for claim. Those activities being eating, bathing, being able to dress oneself, using the facilities by oneself, transferring, which is like literally just being able to move out of a chair into a bed, moving around one's home, incontinence, which is the ability to maintain bladder and bowel function. Being unable to do 2 of those 6 it qualifies one for claim, or having a cognitive impairment. Cognitive impairment qualifies the client independently. So some form of dementia like Alzheimer's would independently qualify the client for claim. So we've come a long way. So we've talked about what long-term care is, the expense associated with it, how it can be paid for, and we've talked about policy structure. But how do we communicate with clients in a way that they understand, that they can gravitate towards? The first thing I think is when you talk to them. Advisors that we see who have the most success are bringing it up to clients in their early 50s. I'm having all of my clients over age 50 participate in a long-term care evaluation. We need to come up with a plan for how you're going to receive care. And I'm going to show you insurance options. And I want to show you those options while you're young and healthy, because I simply have too many clients want it when they need it. And that's a reality, because it's pass fail. So for those of you familiar with life insurance, life insurance, you've got a standard risk, you got the preferred risk, and then you got, the Adonis rate class. Under standard, you have table ratings, 12 to 16 tables. Each table with term insurance being about a 25% increase over standard. My point is that even somebody who's ill, if they're willing to pay for it, can generally get life insurance. Long-term care insurance, you're in or you're out. If there's any signs of smoke, and I don't mean tobacco smoke or nicotine smoke, I'm saying like any signs of a problem, the client's not going to be able to qualify for claim, or qualify for the new insurance. And you can see here for the American Association of Long-Term Care, the declination rates. So by age 70, almost half of the applicants are rejected due to health. But you can see under 50, the likelihood of being declined is relatively minimal. So in a client's 50s, they get a lot of leverage out of their premium dollars. They've got a lot of earned income years still ahead of them to pay the premium, and they're likely still very insurable. So when you bring this up, really does matter. Early 50s for a lot of clients, unless you have a particularly high income earning client, then maybe late 40s might be a good time as well. So I mentioned simple communication that clients can really gravitate towards. The easiest way to communicate the value of hybrid long-term care insurance is real simple. Client, think about 3 buckets. Bucket number 1 is your live bucket. Your live bucket provides a robust pool of money for long-term care. And if you need care, you're able to receive monthly benefits income tax free. If you happen to pass away and don't use the insurance, there's your die bucket. And that pays an income tax free death benefit to your heirs or to your beneficiaries. And then there's a quit bucket. In other words, if you get down the road and you feel like this isn't the best solution for you, or you have some sort of financial emergency and you need to get to the cash, there's in case of fire, break glass feature to it where you can surrender the plan and get back some or all of your money. I say some or all because you can structure it to get back 100% return of premium, or the client can choose to have maybe 70% return of premium, and by only taking 70, leverage up their long-term care benefits. So I mentioned that there's relatively few carriers in the hybrid space. really 5 or 6 that are regularly competitive, and have good, solid, guaranteed products. Most of them all modeled their product after one carrier. So when you pull out the illustrations, it's not like the life insurance world where it's like, oh my gosh, what am I reading here? They all look completely different. They actually look pretty darn similar. So I'm going to walk you through what a sort of a generic one to give you an idea of how to associate that live, die, quit with what you're actually looking at in an illustration. So here in the illustration, you have your live bucket, your live column, your die column, and then the quit column. So starting on the left here, you've got the planned premium. This is what's called a 10 pay. 10 pay means on a guaranteed basis, the client pays 10 guaranteed premiums and then it's paid up. The premium amount is fully guaranteed, so is the duration. So during the premium paying years, the insurance carrier can't come back and ask for more money. And after the premium is paid, they can't come back and have rate increases or anything like that, or ask for another premium, assuming the plan is fully guaranteed and the majority of the top ones are. So that is the premium. Then you have your quit. You can see here that this product is set to 70% return of premium. As I said, 100% is available, but a lot of people go to 70% because it's unlikely that they're going to surrender, and they're willing to take 70% back if that need does come up so that they can get more long-term care benefits. But what you can see here is that if you go up to year 1, year 2, the client's able to surrender on a guaranteed basis and get back 70%. First year they paid in 10,000, they can get back 7,000. Second year they paid in 20,000. 70% of 20,000 is 14. And you see so on and so forth. And as you go down all years, you get back at least 70%. Then you have the die bucket. The die bucket is the death benefit. This is the income tax free death benefit that gets paid to one's heirs. The way it works is that any long-term care claim that's paid drops that death benefit dollar for dollar. So let's say, we've got a client here in my example at age 80, there's a $100,000 death benefit, and they've used $50,000 of long-term care money. At that point, if they were to pass away, the family receives $50,000 income tax free. Let's say in that same scenario, the client passes away and they've gone through $150,000 of long-term care money, more than the amount of death benefit. There's always a residual death benefit that pays, generally between $5,000 and $15,000 that helps the family with final expenses. Then you've got the live bucket. This is the long-term care bucket. And you can see that the compound inflation protection is growing over time. So let's look at age 85, which is close to claim time. What we see here is that by age 85, on a guaranteed basis, the long-term care pool has grown to $589,000, of which the client can access $91,000 a year or $7,600, income tax free. Now, a lot of times, financial planners in particular have the mentality of, okay, is that a good use of the client's money? Can I do better in the market? The first thing I would challenge you to consider is that this isn't about investing. This is an insurance product. This is about transferring risk that could be catastrophic to a portfolio. And it's just like transferring any other risk. If your client has a home, they should have homeowners insurance because it's a big potential risk. Auto insurance, they probably have collision. Even if they could total their car today and stroke a check tomorrow and still have the same lifestyle, there's value in transferring risk. But there is value in the insurance. In other words, if in this example, the client went on claim at age 85, and it's a 4-year benefit period, and they stayed on claim the whole time and used the monthly maximum, the internal rate of return on those it's 8.3%. So using a portfolio, the portfolio would have to be invested pretty aggressively, have to get a pretty strong 8% plus return, and also these benefits pay income tax free. So the pre-tax equivalent on these numbers is quite high. So again, it's about transferring risk. It's not an investment, but if you do look at the value of the dollar spent, there is significant value there. So what are the most common funding methods? Number one, earned income. High income earners, are in their early 50s, really desire to have it paid up by the time they reach retirement. Do 10 payments, 15 payments, have it paid up by the time they reach retirement. Low yield assets, cash sitting on the sideline, not doing anything for them. Client, why are you sitting on so much cash? I like to know that it's there just in case. The hybrid plans with the return of premium feature provide that same in case of fire break glass feature, but it leverages those dollars for long-term care, which again is a need that's quite strong. And then existing life insurance. Clients have a life insurance portfolio, and let's say they're in their 50s and they have whole life insurance or any type of permanent life insurance. And they got it when their kids were young. Now the kids are grown, they're financially secure. And the need to the family isn't so much like what happens if mom or dad passes away. The need to the family is like, well, what happens to the kids if mom and dad live too long and they have to be caregivers? Repositioning that asset in the cash value in that existing life insurance to fund the hybrid plan for a lot of clients, it's found money. It's not usually money that they've earmarked for retirement. It's money that's in their life insurance. So if you can show them how to exchange that to address a changing need that's now long-term care insurance that still can provide a death benefit, that's usually very welcome. And a lot of these policies, if it doesn't take care of the whole premium, it could provide for a large portion of it. And also, it says life insurance, but an annuity with a low basis and a big gain, doing 1035 exchange into a hybrid annuity, and really leveraging up that cash value and getting those benefits income tax free when the long-term care claim is paid can also be quite attractive in a great way to fund it. So here's some key takeaways. These are the things that you can do today that can immediately bring value to your client relationships and really improve the quality of life for your clients and for their loved ones. Number one is consider exploring long-term care insurance for yourself. Even if you go in with the assumption of, I'm not going to buy anything, fine. But complete a questionnaire and look at the product options for yourself. There's nothing that will help you connect with the value better than seeing it from the client's viewpoint. And it'll really help you understand the product, and it'll help you get comfortable with the discussion. And more likely, you probably need it too. Create a consistent process. If you don't have a process built in, then the only time you're going to really have these long-term care discussions is when a client brings it up and it's proactive. The advisors who have the most success are bringing it up to clients on a regular basis when the client turns 50. It's a regular agenda item. If you bring it up with clients when they turn 50, even if they don't immediately implement a solution and they take 2 or 3 or 4 years, they're still in their mid-50s. They're still going to get a lot of leverage out of their premium dollars. They've had a lot of time to think about it, and they're still likely very insurable. But like anything, if you don't put a process to it, it will never become a regular discussion and solution for your clients. And then lastly, consider a virtual training session like this one. If you are willing to put together a webinar with your clients, we can have myself or somebody from BUI, if you have a minimum number of participants, we'll come in and do a similar session, a lot shorter. So we usually do it in 25, 30 minutes, go over the need, the basics of the product. You can brand it with your own company's imagery, logos, or whatever. We'll help answer the questions, but we'll make it as easy as possible. And a lot of times that's a very comfortable way to introduce it to clients on more of a mass level than on an individual level. But sometimes it's the combination of those two things that really makes it happen. So with that said, happy to answer. I don't know if there are any questions. If there are, happy to answer them now. And if nothing else, remember to sign in for your CE.
Brant, thank you. That was excellent. And we do actually have quite a few questions. And so
Okay.
I'll consolidate a few of these, but we'll start with at what age or phase of life of clients does it make sense to look at obtaining LTC policies?
I think early 50s. High level of insurability, a lot of leverage on premium dollars. If it's a high income earner in their 40s, and the reason I say, I mean, usually the earlier you start planning, the better, right? But I'm just trying to be realistic that people in their 40s are dealing, especially in the late 40s, dealing with college funding and things like that. And so early 50s is usually a time where people are a little bit more receptive to it.
Excellent. Next question. So does BUI have a long-term care questionnaire available?
Yeah, so we have a process called long-term care evaluation. And we have a client explanation piece that explains to the clients, why you need to explore long-term care insurance and the value of participating and ultimately how the process works. But we have a digital information gathering kit. The information gathering kit helps us drill down onto the client goals and objectives. Like, what are they really concerned about? And then based upon those goals and objectives, the concerns that they mark medium to high, we create a customized analysis with solutions that directly relate to their concerns, that relates to the cost of care in their area. And 9 out of 10 times, there's somebody at BUI that's assisting in the presentation to help answer questions, help lead the meeting, and there's no reduction in compensation. So if anybody's interested in that, that is under the planning tab of our website under evaluations, you'll see the long-term care questionnaire.
Fantastic. I'll actually take this next one. Did the Secure Act or the Secure Act 2.0 do anything to change LTC? And the Secure Act 2.0 did include a provision for LTC allowing for retirement plan distributions of up to $2,500 per year to pay long-term care insurance premiums. It didn't define the type of contract, so we're still waiting for some additional guidance from the government on that. And it doesn't actually kick in until 2025, so it's something that we'll probably hear more about in 2024, I would have to guess. That was the most significant change that the Secure Act 2.0 brought about for long-term care.
Yeah, that $2,500 being a way of getting around the 10% early withdrawal penalty, but it's still income taxable. So everybody was kind of hoping that it would be, the government is trying to encourage us to do this. $2,500 out of a qualified fund, income tax free to fund long-term care premiums, I think would have been very beneficial. It really would have encouraged clients. We didn't quite get there, but we'll see what comes down the pike.
Yeah, a lot of disappointment with that one. Agreed. Do you know the percentage of people that have a long-term care event that lasts longer than 100 days?
Ooh, no, I can tell you that the average long-term care event for a female is 3.7 years. The average for a male is 2.3 years. Most.
Great. Is a 2 to 3 year stay in a long-term care facility still average? Is that a sufficient time frame for coverage?
It depends upon the client's portfolio. And one of the things is, if a client has $1 million portfolio, an extended stay can be absolutely detrimental. If a client has a $10 million portfolio, there's value in transferring risk, but that's a point where you might start looking and saying, how much do we want to shoulder on the portfolio, and what percentage do we want to transfer onto an insurance company? The reality is that averages can be really misleading. If you have somebody that has a cognitive impairment, the things that affect our mortality adversely, like eating poorly, drinking poorly, or drinking, gambling, things like that, smoking, people stop doing when they have cognitive impairment, and they can live a really long time. So 2 or 3 years may, it's better than nothing, but a lot of plans today are like 4 and 6 year benefit periods. And part of the reason is just because the pricing. Some of these 4 and 6 year benefit periods, you look at them next to a 3 year benefit period, and it's like, wow, you get a lot more bang for your buck just by going for that extra year. And it's not, proportionally more premium. So that's one of the things that we always look at is what's going to be the best deal for the client.
Great. All right, we'll take a couple more. I know we're past time, but can you clarify, does the 70% return of premium allow the client to continue receiving LTC benefits?
No, that's a return of premium upon surrender. So the client's surrendering their contract and that's it.
Great. And what typically disqualifies those from qualifying for coverage? Are there specific major medical issues?
Yeah. So number one is anybody that's in physical therapy for pretty much any reason is going to be either declined or postponed. We had a healthy attorney, runner, had a rotator, had rotator cuff surgery, was in physical therapy for that. Otherwise, mortality wise, life insurance would have been best class, got postponed. But then like the automatic declines, if the client's using a cane, if they're on memory medication, no matter the dose, if they've had conversations with their doctor about concerns about memory, anything that is affecting their morbidity and really their mobility is going to have an adverse effect and probably decline them. So that's why it's really important to have a conversation with them before they've had any of those issues, because you never know when that's going to happen.
Very good. And we'll take one last one because it's a repeat of a question that you answered, but just to clarify, where again would someone find the long-term care evaluation questionnaire?
So one, you can email any of your friends at BUI, and we can email it right back to you. I actually forgot. If you pull up your camera and just hover over this image, it will pull up. You'll see it'll say long-term care form, and you just click it. That'll take you to the directly to the form. It's also on our website under evaluations. So you'll see planning tools, evaluations, and then you'll see all of our evaluation processes. They all are initiated through completing an information gathering kit. So whether it's long-term care, or you want to have an estate plan reviewed, or you want to review a client's existing permanent life insurance policy, you basically complete that information gathering kit. It's digital. It'll come to us. We'll put together an analysis. We'll review the analysis with you, the advisor, and then join you in the meeting if you want us.
Fantastic. And one last comment for anyone who had any issues with completing the CE credit form, feel free to contact anyone at BUI and let us know, and we'll be happy to ensure that you are added to the list for credit. So I want to thank everyone for attending today. Brant, thank you for an excellent presentation, and hopefully everyone has a great rest of the day. Bye-bye.
Thank you.